Forex traders, be cautious. The U.S. debt ceiling is a legal limit on how much the federal government can borrow to pay its bills. It is set by Congress and has been raised or suspended many times in the past. The debt ceiling affects not only the U.S. economy, but also the global financial markets, especially the Forex market. The U.S. dollar is the world's reserve currency and the most traded currency in the Forex market. What is the debt ceiling and why does it matter? The debt ceiling is a statutory limit on how much money the U.S. Treasury can borrow to fund the government's spending obligations, such as paying interest on existing debt, Social Security benefits, military salaries, and other programs. As of October 2021, the U.S. national debt stands at about $28.8 trillion, which exceeds the GDP of $22.7 trillion. If Congress does not raise or suspend the debt ceiling by December 3, 2021, the Treasury will run out of cash and extraordinary measures to keep paying its bills. It would also trigger a sharp rise in interest rates, a plunge in stock and bond markets, a flight to safety from risky assets, a weakening of the dollar, and a disruption of trade and financial flows. How does the debt ceiling affect Forex trading? The debt ceiling affects Forex trading mainly through its impact on the U.S. dollar and its role as a global reserve currency. The U.S. dollar accounts for about 60% of global foreign exchange reserves and about 88% of global Forex transactions. The value and stability of the dollar depend largely on its perceived safety and liquidity in times of stress or uncertainty. The debt ceiling creates both stress and uncertainty for Forex traders, as they have to factor in the possibility of a default or downgrade on the U.S. debt, which could erode the confidence and demand for the dollar. A weaker dollar means lower interest rates and lower returns for dollar-denominated assets, which could reduce the demand for the dollar and make it less attractive for investors. Risk appetite refers to the willingness of investors to take on more or less risk in their portfolios. How should Forex traders react if the U.S. raises debt ceiling? Forex traders should react to the debt ceiling issue by being prepared for different scenarios and outcomes, and by adjusting their strategies accordingly. Here are some possible ways to react if the U.S. raises debt ceiling. Monitor the news and market sentiment closely. Forex traders should stay informed of the latest developments and how they affect market sentiment and expectations. Be flexible and adaptable. Forex traders should be ready to adapt their positions and strategies as new information emerges and market conditions change. Hedge against currency risk. Forex traders who have exposure to the U.S. dollar or other currencies that could be affected by the debt ceiling issue should consider hedging against currency risk. Forex traders who want to reduce their exposure to currency risk should diversify their portfolios across different currencies and assets that have different correlations with the US dollar and the debt ceiling issue. Diversifying can help reduce the overall volatility and risk of a portfolio by offsetting losses in one currency or asset with gains in another. For example, Forex traders could invest in commodities, such as oil, gold, or copper, which tend to rise in value when the dollar weakens. How will the debt ceiling outcome affect interest rates and risk appetite? The debt ceiling outcome could affect interest rates and risk appetite in different ways depending on the scenario. How can I hedge against currency risk related to the debt ceiling issue? You can hedge against currency risk related to the debt ceiling issue by taking an opposite position in another currency or asset that is expected to move in the opposite direction of the original position. How can I improve my Forex trading skills and strategies related to the debt ceiling issue? You can improve your Forex trading skills and strategies related to the debt ceiling issue by educating yourself on the fundamentals and technicals of Forex trading. Forex traders should be aware of the potential scenarios and outcomes of the debt ceiling issue, how they could affect the value and stability of the US dollar and other currencies. Forex traders should also be prepared for different scenarios and outcomes by adjusting their strategies accordingly, hedging against currency risk. Diversifying across currencies and assets, considering alternative investments, and improving their Forex trading skills and strategies. One last possible move. Major investors will transition to precious metals such as gold. This means traders should focus on buying gold more, while selling dollars. Other currencies may improve against the dollar. Subscribe for more tips.